Mike, it's great to see you. So, a little bit of good, a little bit of bad here. The stock is going up. What was your read on the numbers?
Yeah, the miss was really small. The same store sales missed by like 10 basis points, and it was the best comp that they've had in about 2 years. A lot of the underlying metrics are showing, better demand. Not where we were, many years ago or during the pandemic, but certainly a lot better than the post-pandemic era. And again, the best in a couple of years. The earnings miss 3 pennies, just a little bit of a higher expense rate and sort of noise, if you ask me. This is more just about the better trend and underlying demand that we're seeing, combined with the idea that we think the Fed's going to get more hawkish, particularly when Jerome Powell's term is up and the administration puts in a new Fed chair. We think we'll see lower Fed funds rate, and that doesn't always translate into a lower long end of the yield curve. In other words, lower mortgage rate. But generally speaking, if you apply the average spread between the Fed funds rate and the 30-year mortgage rate, that would dictate that rates will come down. And if we see mortgage rates, they're already in the mid sixes, which is down from where they were. And if they were to get to low sixes, maybe even a high five, that's really going to drive demand. And I think that's what investors are looking ahead towards.
Well, to that point, I want to read for you a quote that our executive editor, Brian Sozzi, spoke with the CFO of Home Depot, Richard McPhail. And he talked about rates. He said, our customers are looking at long rates right now. We think that the most important borrowing rates for our customers are mortgage rates and HELOC rates, home equity lines. They are still quite elevated, he said, to recent history. And we know that is leading our customers to defer large projects. It's hard to say what rates may have to do to unlock that spend, but our customers do tell us they are deferring, they're not canceling. I mean, and this goes to the question of across anything having to do with housing right now, Mike, which is, what rate is low enough to unlock everything that's frozen? What rate are you looking for?
Well, there are a couple ways I think about that. One is that true, there's still a little bit of lack of spending there, but it's not getting worse. And in fact, it's actually getting a little bit better. So sure, there's still a lot of pent up demand, a lot of lack of these big ticket purchases. But Home Depot does disclose their comp sales for tickets that are $1,000 or higher. That was up 2.6%. It's actually the best it's been in about 3 years since in the post-pandemic era. So you're starting to get there. A long way to go. To answer your question more directly, what kind of mortgage rate do we need to really start to unlock some demand? I think a 5 handle. I think something with a 5 would really start to drive some existing home sales growth, which has been very weak. 4 million or less. We'll get the latest number on Thursday. That has been weak. Interestingly, though, pricing has been very strong, and I think it's pricing that drives the HELOC data, the home equity loan data, and that's at record highs right now. It's just going to take maybe a little bit of a lower interest rate and a little bit of an impetus to get consumers to spend on that equity in their home.
So to go back for a moment to the comp sales chart that we put up a few minutes ago for Home Depot, and the big pandemic surge that we saw, then the negative, like what is the normal level for Home Depot, do you think? What's, whatever normal means. And when do we get back to that? Or have we gotten past that inflection point?
Yeah, if I had to pick a normal level, I'd say 3.5. We should get a percent or two from increased transactions, a percent or two from higher pricing. And that historically should all translate into somewhere in a 3 to 4% comp. That's the right long-term level, we think, for Home Depot. That's where we were prior to the pandemic. You had a big bubble in 2008 or prior to 2008, then a big crash. But generally speaking, over time, it's in that 3 to 4% range. It's been a while since we've been there, but we think that's where we're tracking towards. So 1% comp this quarter, the best it's been in a couple of years, but still a long way to go. Nobody's buying Home Depot today because we think we're sticking at a 1% comp.
Right.
The idea is that we think we're getting ahead of a return to that average level. When we get there, hard to say. But again, mortgage rates coming down, seeing a little bit better demand. The consumer in general is out there spending.
Right.
We think we're getting there. And on our model, at least, we have it towards the end of 2026.
Okay, so still a little ways off, but nonetheless within sight. So now that we've heard from Home Depot, what does that tell us about the rest of the season? Or are we really going to have quite a retail, case by case kind of situation?
Yeah, there'll be a couple. So Home Depot, idiosyncratic, of course, because of the focus on the home, and so it is a read through for Lowe's, and we think it tells us that Lowe's should have a decent comp tomorrow, and at least be able to talk about some signs of better underlying demand. But as it relates to all of retail, there are a couple of themes that we expect to see that were exhibited in Home Depot's results, and we think themes across different retail verticals. It's things like the consumer spending. Again, this is the best comp it's been in a couple of years. We saw this in the retail sales numbers that came out on Friday. We see it in a lot of other data points that we're looking at. The consumer is out there spending. So that's one thing we saw. Secondly, tariffs are starting to show up. Home Depot had a form of price increases that helped the comps. And when I say a form of price increases, what they did is they promoted less. That's a price increase. And they did say that was a function of trying to protect margins from tariffs. So we're going to start to see that. That being said, the tariff scenario right now is, we think the worst case scenario is off the table. Remember when a lot of these retailers last spoke in May, that was coming right off of Liberation Day, and there was concerns of really big tariff numbers. Tariffs are here, they're not going away, but they're probably better than the worst case scenario. And so where that's showing up is that's enabling companies to maintain their guidance because it's no worse than they thought. In fact, it might even be a little bit better.
Right.
One more thing I'd say is inventories. Inventories, we think companies pre-bought. Inventories are going to start to come down, and we do think what we're going to see is a little bit of a conservative inventory outlook for the back half of the year. Retailers are going to sacrifice sales for margins, we think, and really be conservative with their inventory ordering.
That is an important note to watch, sales sacrifice for margins. Mike, good to catch up with you. Thanks for joining us.
Great to be here. Thanks.
I can't think of a better company, at least today, offering up more clues on the economic outlook than a Home Depot. Where do you stand on the S&P 500 this year? I know you and I have talked in the past, and you've been pretty bearish.
Yeah, I mean, I think Home Depot stock is up today because investors were worried that they would guide lower for the year. They didn't, but the earnings were not particularly good. And certainly the outlook for the housing market remains fairly weak. So we got housing starts today. They did increase, but building permits, which tend to lead housing starts, fell to a fresh lowest number since the pandemic. If you look at inventories of newly built homes, they're the highest since late 2009. Home prices, whether it be the Case-Shiller index or other indices, are falling. So this is not a good state for the housing market. And that's important because the housing market is a leading indicator for the economy. It's also a bellwether that tells us whether monetary policy is still tight. And the housing market is saying that it is, which means that the risks to economic growth are to the downside. And that in turn implies that the risks to stocks are to the downside.
As we know, rate cuts are important for not just small caps, important for almost everything. And falling squarely into that category is Home Depot and the implications for when people do work on their homes, what kind of work, et cetera. Brooke, what did we hear from Home Depot last quarter?
Yeah, right now the street is reacting. Keep in mind that this report missed on revenue, missed on earnings, and missed on same-store sales growth. They also reiterated their guidance. But right now, shares are moving higher in this pre-market trading hours. And what exactly has investors excited is this potential that consumers are either going to just get used to higher interest rates or that we'll see lower interest rates on the horizon. Other commentary that has Wall Street excited right now, the CEO just now saying on the call that customers are engaging more broadly in smaller home improvement projects. He went on to say that performance across the business was the strongest that they've seen in 2 years. And so perhaps that customers getting used to or hoping for lower interest rates is top of mind. Also keep in mind some commentary that we also got out this morning is that May and June same-store sales growth was largely muted, but they did see a huge improvement in July. We know that these summer months are key game changers for Home Depot as consumers really lean into home improvement projects, and of course that may be backyard projects as well.
Yes, we'll see how that all plays out. And we're going to be talking about those themes of rate cuts and also home equity lines and all of that actually throughout the day. So thanks so much, Brooke, Josh, appreciate it.